All right, so today we want to talk about multiples. And as we previously mentioned before, there are 6 multiples that we are going to apply to company analysis. So those are the 3 enterprise value ratios: EV to sales, EV to EBITDA, EV to EBIT, the price to earnings ratio, the PEG ratio, and the price to book ratio. So as part of your group projects, what you're going to have to do is you're going to have to do this multiple analysis on your company plus 5 peers. So 6 total companies. All right. So 6 companies by these 6 ratios. All right. And so you're going to have to then explain the multiple analysis. So what I'm going to do today is show you how to get the data from Bloomberg for the multiples, and then how we would analyze the multiples and interpret them as part of our assignment. Okay? So we will be using Bloomberg to get the data. So I'm going to switch here to Bloomberg. And the company that we're going to use as a working example today is Coca-Cola. Right? So remember that when you do this next week for your graded homework assignment, you're going to have to do the same thing that I'm doing here today. Okay? I'll give you a different company than Coke, but basically you'll have to do a similar process. So you go to the Bloomberg lab, you log in. Once you've logged in, type in the company, in this case Coca-Cola, U.S. equity, and go to their screen. Now we're going to be using Bloomberg pretty heavily over the next few weeks, and there's going to be 2 areas of Bloomberg that we're going to get a lot of data from. One is called financial analysis, or FA, and the other is called relative value, or RV. What the FA section of Bloomberg does is it allows you to get companies' ratios data historically. Right? So I can get all sorts of historical data for a company. What the RV section of Bloomberg allows you to do is it allows you to compare multiple companies against their financial information for the current period. Okay, so that's the main difference between the 2 sections. RV, compare across companies the ratios. FA, compare historically the single company's ratios. So in this case, to do multiples analysis, we're going to go to the RV section. Now, once we do click on the RV section for Coca-Cola, it's going to bring up this screen. And typically, it'll either bring up what's called the GICS comp list or the Bloomberg Pure list. If it brings up the GICS comp list, then this is the Global Industry Classification Service list of comps. So basically, these are the standardized peers by industry. So in this case, this is looking at the beverage industry and all of the companies related to Coca-Cola that are tied to the beverage industry. It also does it by default country of domicile. So since Coke is a U.S. company, it'll compare Coke's U.S. peers. If I wanted to look at Coke's international peers, I could switch this to a global list, and it would add in global companies to this list. Okay? Now, for purposes of our analysis, we're going to just focus on U.S. companies and U.S. peers. So in this case, I'll go back to countries of domicile since we're just dealing with U.S. companies. What we're also going to do is, rather than using the standard industry classifications, we're going to use the Bloomberg peers. So the comp source we're going to want is the Bloomberg comps. So the difference is, with the Bloomberg comps, somebody at Bloomberg has gone through and identified manually who they think the peers are for these companies. Right? So you notice it's a shorter list. Now, for our assignment, we're going to need 5 peers plus our own company. And you'll notice for Coca-Cola, there's more than 5 companies on this list. So here's the other advantage of the Bloomberg comps, which is I can edit this list. If I do the GICS list, I can't edit it. But if I use the Bloomberg peers, I can edit the list of peers. So what I'm going to do here is I'm going to edit the comparables. And it's going to show me the same list, but now there's some check boxes. If I uncheck a box, when I save it, it'll remove the company from the list. If I want to add a peer that wasn't on the list to the list, I could type in their company name or ticker symbol up here and add it to my list. So essentially it allows me to create a custom list of peers. So in this case, what I'm going to do is I'm going to start removing peers from this list. So I'll leave on Pepsi, I'll leave on Dr. Pepper, I'll leave on Monster, I'll leave on Coca-Cola Enterprises, which are the bottlers for Coca-Cola. I'm going to take off Molson Coors. I'm going to leave on Brown-Forman, take off Constellation, take off Beam, take off Green Mountain Coffee, take off Boston Beer, and I'm going to hit save. Now, because I had done this in a previous section, I already had a custom list. It would have just saved this to my custom list. It's basically saying, do I want to override my custom list? Hit yes, and I now have a saved custom list of comps. So when I go back to Coke, these will be my custom peers that I will see under the RV section. Right? Now, the advantage of the RV section is I then have a series of templates that I can use to quickly see data across the peers. And if I want to create my own template, I can go to the custom section. So that's what we're going to do. We're going to create our own custom template. So if I click on custom, then it'll allow me to create my own custom template. So I can create my own peers. So for example, I created this custom template previously called DuPont, which are the DuPont ratios. Later, if I click on a template that I've already created, it will basically take this template with all the DuPont ratios, all the companies, and then give me all that data in real time. Right? So it's a little bit tedious to set up the first time my templates, but once I do, I can reuse that template for any company, and it makes it much more efficient to get data out of Bloomberg. So that's what we're going to have to do. We're going to have to get the multiples data out of Bloomberg, and this is the easiest way to do it. Now, you could choose to do this manually. Right? You can choose to manually get all the custom data out of Bloomberg, type it into a spreadsheet, and aggregate it yourself. All right, that is an option. I think this is an easier option for you than doing it manually. By the way, if you were to do it manually, you would go to the EEO screen. EEO, Earnings Estimate Overview. At the bottom of the screen, it has 5 of the 6 multiples. EV to sales, EV to EBITDA, EV to EBIT, price to earnings, price to book. The only one that's missing is the PEG ratio. If I switch to quarterly to annual view, then it will give me these ratios for forward multiples of the forward years. Now remember, when we do multiples, we care more about forward multiples than historical multiples because we care more about forecasted cash flows than historical cash flows when we do the valuations. So what we're going to care about is the current year's forward multiple and year plus 1 forward multiple, which is 2 years out, or the 2013 multiple for Coke and the 2014 multiples for Coke. All right, so we're going to care about the current year and the year plus 1, which are the next 2 years worth of forward multiples. So we're going to need that for EV, the PE, price to book, and the PEG ratios. So again, I could manually do this company by company, take screenshots or export the data and manually type it in. Or, as I said, what I'm going to recommend is we're going to do this on the RV screen. So I have my custom list of peers for Coke. I'm going to go to the custom tab and I'm going to start creating my own multiples template. Now, if I have already have some fields in here and I want to remove them, it's easy to do by right-clicking and then deleting the column. So I'm going to wipe out those 2 columns. All right, so right now I just have the names of the companies. So I'll start out with the EV multiples. The first multiple I want is EV to sales. So I can literally start typing in EV space TO space sales. And Bloomberg will show me its filtered results for top matches. In this case, you can see I have EV to this year's sales and EV to next year's sales already as ratios that Bloomberg has in its database. Right? So what I want to do is I want to take EV to this year's estimated sales, click on that, hit enter, and it'll add EV to sales to my template. Okay? I'm going to do the same thing. EV to sales, and then I want next year's sales. Now, by the way, there's a third option on here called best sales. Best stands for Bloomberg estimate. So Bloomberg estimate means I can go into the forward analyst data where they've uploaded all the estimates, and I could actually choose my own periods. So where Bloomberg actually says give me current year and forward year, let's say I wanted 2 years out or 3 years out, I can go into the EV to best sales and say choose 3 years out, choose 2 years out, choose historical data if I wanted to get a historical ratio. So it gives me more flexibility if I don't have a predefined ratio in Bloomberg to define my own time periods. But in this case, I have the time period defined, so I'm going to do EV to next year's sales. Click on that, hit enter. Do the same thing with EBITDA. EV to EBITDA. Oh, actually, make sure I type it here. EV to EBITDA. So again, EV to EBITDA this year. EV to EBITDA next year. Okay. Next, EV to EBIT. EV to EBIT. And so again, it's finding EBITDA first. Show more matches. And I can see the other items in the list. So if I scroll down here, I have EV to this year's EBIT. Select. EV to EBIT. Show more matches. EV to next year's EBIT. Select. Okay, so I now have my enterprise value ratios for the current and the next forward year. Okay, so those 6 ratios. Right. Next, I need my price to earnings ratio. So again, P/E, and I can see my best PE ratio. And you can see I have my PE ratio for now. And what I want is for the current year, because best current year, since the Bloomberg estimate is actually the forward year, the uncompleted current year. And then I want PE for the year plus 1. So PE for next year, which would for Coke be the 2014 PE. Right? Next, I need the PEG ratio. So I'm going to type in PEG. Actually, I should type it in here. PEG. And I want my best PEG ratio. For the current year. And we're only going to use 1 PEG ratio instead of 2. Right? And then finally, we're going to do our price to book ratio. So you can just type in P/B. And so again, we're going to use the current price to book ratio. And those are our multiples. Okay? And then I'm going to add one more item to this list. The final item I'm going to add to this list is the long-term growth rate. So that we know that growth and ROIC drive multiples. So I want to see what the growth rate that they're using when they calculate the PEG ratio. So I can type in LTG for the long-term growth rate. So I want my best long-term growth rate. Hit enter, and I now have my long-term growth rate for the companies. Right? So I've just basically created the template that I want to save and reuse. So that's my final step. Save the template. Because if I leave the page, everything I've done will be lost, and it will be very annoying to have to recreate it again. So I'm going to save this, and I'll call this multiples 443. Save. And you'll notice that it'll put the template as a little box right here on my menu. So anytime I click on that, it'll load that template. All right? Questions about what I just did here? Now, you can't share templates across Bloomberg accounts. So that means each and every one of you are going to have to create the template yourself for your Bloomberg account. Okay? So I can't give this template to all of you. You would have to recreate the template yourself because the templates are tied to your individual login. But as I said, once you've created the template, then it's here and ready to use. All right. The final step for the template is that we're going to want to have industry average data. So on the bottom, it'll say select stats. And if I click on select stats, I'm going to choose market cap weighted average. Right? So instead of just taking a straight average of all the ratios, it's going to weight the averages based on the size of the companies. And I'm going to hit update. So it's going to add a new line. So basically that's the average multiple based on size of those firms that are in my list below. Okay? So I've now created my template for multiples. I'm ready to export it to Excel. So I hit Output, Excel, and in the lab, it will then dump all of the data to an Excel template. Right? So this will be useful for us. I've done this in the previous class. Hit yes. And it would then put all the data in Excel. It'll be useful to us because then I can take this Excel file outside the lab, do analysis at my own leisure. Right? Except remember that these numbers at this point aren't actually numbers. So they're database lookups. Now the nice thing about this is if I open up this Excel file again at a Bloomberg terminal, it'll go to Bloomberg and it'll download the most recent data. The problem though is if I open up the Excel file and I'm not in a Bloomberg terminal, then it's just going to give me errors. So if I want to leave the lab and not use it at a Bloomberg terminal, I got to convert these numbers or these fields to numbers. So the simplest way to do this is to select the entire spreadsheet, copy the entire spreadsheet, and then paste special values. So it'll basically replace all the formulas with numbers. So I now have numbers where I used to have values. I can now save the file, put it on a thumb drive or whatever, email to myself, leave the lab. I now have all the data for doing my analysis, either for my group project or any of the homework assignments. Okay? Process question. Questions about any of that? Hopefully pretty straightforward. Okay, so the next step is we're going to do the analysis. And I'm going to go back to the original Bloomberg screen just so that we can do the analysis right off of this screen. Right. So, key to the analysis that we want to do, and this is going to be what you're going to do on your group projects as well as your homework assignments, is that remember that generally growth and ROIC are the primary drivers of multiples. And we're going to start out with an assumption with this list. The assumption that we're going to start out with is that because we've chosen true peers of our company, that there shouldn't be much of a difference in cost of capital. There shouldn't be much of a difference in tax rate. There shouldn't be much of a difference in the non-operating items or the capital structures. Right? Now, if we go through our analysis and we can't explain growth and ROIC as the only two remaining factors, then it's probably one of those other factors that we're assuming away. Right? But starting out with that those aren't really the big differentiators, growth and ROIC should interpret the multiples. That's the premise that we're going to start out with the analysis. So the reason why I added the long-term growth rate to this list of data points is if I have the estimate for long-term growth, I have the multiples, so what I'm really missing is the ROIC. Now, a word about this long-term growth rate. This is a long-term growth in earnings per share. And in our valuation models, our G is growth in cash flow. Growth in earnings per share and growth in cash flow are not the same number. But what we're going to do for this analysis is we're going to assume sort of a directional proxy. We're going to assume that companies with a higher growth in earnings per share will have a higher growth in cash flow. It's not necessarily the same magnitude, but because, for example, the PEG ratio uses the growth in earnings per share, then we're going to use the growth in earnings and a higher growth in earnings as a company that has a higher cash flow. Right? So that's just one of the assumptions, an additional assumption we're going to use as we do the math and the analysis. So let's start out by comparing our company, in this case Coca-Cola, against the industry averages and see what these multiples tell us about the expected ROIC of Coca-Cola and why Coke may be trading at a premium or discount in the multiples to the industry average. Right? And we're going to start out with the price to book multiple. The average price to book right now for this industry is 5.72. That should tell us something about the industry right there. Right? Think about a price to book multiple of 1. What would a price to book multiple of 1 tell you, in theory? Basically no spread. Think back to the concept of an economic profit. If we have no spread, we have no economic profit. If we have no economic profit, we've added no value. Therefore, whatever money we've invested, we get exactly that money back. That's what a price to book multiple of 1 means. So a price to book above 1 generally means a positive spread. Price to book below 1, negative spread. More PB, generally more spread. This works out about 80 to 90% of the time. I'll put an asterisk by this because unfortunately, companies can do weird things to their equity. Because book is book value of equity. And if they've made adjustments to equity, it can kind of distort the price to book multiples. So you just need to be aware of that. But generally, if this entire industry has pretty high price to book multiples, it probably means that this industry has a positive ROIC, probably a pretty high ROIC as an industry relative to its cost of capital. Right? That's why we're going to look at ratio number 2, which is called the PEG ratio. The PEG ratio is the PE divided by the growth rate. And in this case, it's the growth in earnings per share. What the PEG ratio tells you is how much am I willing to pay for a unit of growth in earnings. Right? So a higher PEG means I'm willing to pay more for the earnings. So a PEG above 1 means I'm willing to pay more than $1 for $1 of earnings growth. A PEG below 1 means I'm not willing to pay $1 for $1 of earnings growth. Right? So I want to go back to a slide we looked at earlier in the semester, matter of fact, in our second class. And we did an example where we put in a company A and a company B. And we said here were 2 companies that had identical earnings growing at an identical rate. And I asked the question during this class about which company would we pay more for, A or B. And at the time we said universally we would all pay more for B because for the same earnings, B generated more free cash flow. And we said the reason that B generated more free cash flow is because B had a higher return on invested capital. So that's the point. PEG is probably the cleanest multiple for inferring ROIC. Because the reason I'm going to pay more for the earnings is because the company has a higher ROIC. So price to book and PEG both give you information about ROIC, but the PEG is usually cleaner than the price to book because of the adjustments companies make to the book value of the equity. So let's keep that in mind when we're looking at Coca-Cola versus the average and we're trying to discern who has the higher ROIC. So if we just looked at the PEG, who has the higher ROIC, Coke or the market average? Coke, but only slightly. So Coke's ROIC is probably a little bit higher given the PEG ratio than the market, but not too much. 2.28 versus 2.21, not a huge magnitude higher. What's interesting is look at the price to book. The market has a little bit better price to book than Coke. But what's interesting is Coke has a little bit lower growth rate than the market. Now let's look at the enterprise value ratios. Enterprise value to EBITDA and enterprise value to EBIT, Coke is trading at higher multiples for both years than the market weighted average. Coke also has a higher PE ratio for the next 2 years than the market average. Coke has a lower growth rate than the market average. So given all of that data, what can we really say about Coke's ROIC? It's a little bit higher than the market average, because that's the only way with a slightly lower growth that it's going to have better multiples. And the PEG reinforces that. But notice the price to book is a little bit of a conflict with that. And I'm just saying the ratio analysis in the real world will get messy for these reasons. And by the way, I think part of the reason it's getting messy is you got companies like Monster, which have this extreme price to book, and to some degree Brown-Forman, yet their multiples are not all that different. And this is what I meant by companies make these equity adjustments. That's why I think the PEG ratio is actually a better ratio for interpreting ROIC. But we can clearly see that Coke has a little bit better ROIC than the rest of the industry. Now let's think about Coke versus Coca-Cola Enterprises. Coca-Cola Enterprises are the bottlers. So what happened is in the 90s, Coke had a CEO named Roberto Goizueta, and what he decided to do is he decided to take all of the assets of Coke and move them to the bottlers. So that really what Coke was an IP company that controlled the formula and controlled the marketing rights to the company, but it really didn't have a lot of assets. The bottlers would actually create the Coca-Cola, create the drink, mix it, put it in a bottle, distribute, sell it, have the warehouses, have the inventory. Put that in mind. Think about who has the higher ROIC here. Look at the growth rate. Who has the higher growth rate? The bottlers or Coke, the parent? Because remember, the bottlers are actually a separate company, series of separate companies. All right? A little bit higher growth rate here, Coca-Cola Enterprises. Similar to Coke, but a little bit higher. Who's got the higher multiples? The bottlers or Coca-Cola? Coca-Cola, clearly much higher EV to EBITDA, much higher EV to EBIT, higher price to earnings ratio. Look at the PEG ratio. Much lower PEG ratio with the bottlers. Much lower price to book ratio with the bottlers. So for a slightly higher growth rate and much lower multiples, what can we clearly say about the bottlers and their ROIC? It's lower than Coke's. It's also probably much lower than the industry average. So that's the point. The bottlers are trading at much lower multiples because for slightly faster growth, they have much lower ROIC, and that means they're not creating as much value and therefore have lower multiples. Now, the bottlers still have positive spreads. Why can I say the bottlers still have positive spreads? Coca-Cola Enterprises. Because the price to book is almost 4, and the PEG ratio is above 1. So they do have a positive spread. So what I've done here, now again, I can get out the key value drivers for me and start plugging in assumptions and get more granular about what I think the growth rate really is in our model. But without getting into the actual math, I can start to tell a story of, all right, Coke has a little bit higher ROIC than the average, but Coke and the average have a much higher ROIC than the bottlers. All right, so I'm starting to rank these companies as I think about the list of growth and ROIC. All right, now, who's next? Let's look at Monster. All right, Monster energy drinks. That's what Monster is. Let's look at this one. Why is Monster trading at its multiples, and what can we say about the ROIC of Monster? Look at Monster's growth rate. 17%. Monster has the fastest growth rate in the industry. Yet Monster's multiples are far lower than Coca-Cola's and the market average. They also have the lowest PEG in the industry, but they have an extremely high price to book. What can we say about Monster's ROIC? Is it higher or lower than Coca-Cola Enterprises? It's lower than Coca-Cola Enterprises. Why? Because with much faster growth, they have even lower multiples than Coca-Cola Enterprises, particularly on EV to EBITDA. Sorry. Back that up. They have similar EV to EBIT multiples. They actually have slightly higher EV to EBITDA multiples. But really, they have a lower PEG ratio, which suggests a little bit lower ROIC. So why is Monster getting a little bit better multiple here, EV to EBITDA? It's because of the growth rate. Because remember, if you have positive growth rate, then a positive ROIC and a positive growth rate, positive spread and a positive growth rate basically create value together. So Monster is creating value not because they have very high ROIC, but because they have a good high growth combination with the ROIC. So it's really the growth that's causing the Monster multiples to be similar to Coca-Cola Enterprises, but Monster probably has lower ROIC than Coca-Cola Enterprises because they also have the lower PEG ratio. So everybody see how I'm drawing those conclusions? All right, what about Brown-Forman? Now Brown-Forman is actually alcohol. All right, they're bottling and selling alcohol. But what can we say about Brown-Forman and their value? Where do they stack up? Again, look at their PEG. Similar to Coke's, a little bit lower than Coke in the industry average, so probably a little bit lower ROIC than Coke in the industry average, but a much higher growth rate. Their growth rate is 50% higher than Coke in the industry average. So with slightly lower ROIC but much faster growth, that's what's actually given Brown and Forman the very high multiples in the industry. Okay? So basically, the difference is Monster has a much lower ROIC than Brown and Forman. The difference is the high growth rate at Monster is giving them similar multiples to Coca-Cola Enterprises. The high growth rate at Brown and Forman is giving them better multiples than Coke and Pepsi because basically they have slightly lower ROIC but substantially higher than Monster's with a much faster growth rate, creating even more value in the multiples. Right? That's basically what we would need to say in our write-up. That's what we're trying to do. Is we're trying to basically understand the relative order and the relative rankings of the ROICs and how that explains the multiples given the growth rate and given the multiples. Noticing that there's going to be some outliers on there. And as we said, price to book can often be an outlier because companies could have these one-time gains and losses which affect equity. They could be buying back shares which could affect equity. They can do things to manipulate the book value of equity which can distort that ratio. So if companies aren't doing things and the book value of equity is pretty clean, price to book works out pretty well. But you can see even here in this industry, the price to book doesn't work out nearly as well, but the PEG does. Question?
So in this situation, you would rank, if you want to rank those 3 or 4 that we talked about, Brown and Forman would be number 1?
Well, what I would say is, in terms of ROIC, I think Coke and the average have a little bit higher ROIC than Brown and Forman, but Brown and Forman has the higher multiples, mainly because they have slightly lower ROIC, but that much faster growth rate, right? Whereas Monster has much faster growth rate, but an even lower ROIC than Brown and Forman. So that's the major difference. So Brown and Forman has that growth rate with a higher ROIC that's giving them better multiples than Coke and Pepsi. Monster has high growth rate, but not nearly the same ROIC, and that's why they're getting almost similar multiples in some cases, but lower multiples. And that's why similar multiples to Coca-Cola Enterprises, which already we knew had the lower ROIC, and the only difference is that Monster probably has one of the lowest ROICs in the industry, and they're getting value from their growth. All right, so again, we can kind of see that Brown and Forman is getting value from growth and ROIC combined. Coke and Pepsi are getting slower growth but higher ROICs. And we can kind of see that Monster is very fast growth but low ROIC, and that kind of explains the differences in the multiples. That's the level of analysis that I need us to kind of think through. Questions about that?